Have you ever actually stopped to wonder what keeps the gears of the global economy turning? I mean, every single day, literally trillions of dollars move silently in the background. We're talking about the kind of money that powers your local bank, funds multinational megacorporations, and honestly, keeps entire nations afloat. Well, welcome to this explainer. Today we are decoding the hidden, highly structured mechanics of the global financial engine. And I promise you, once you see how this machinery really operates, you are never going to read a financial news the exact same way again. Most people, they just look at the stock ticker and think they're seeing the whole picture. But actually, scratch that. That's just the tip of the iceberg. There's this entire infrastructure underneath it all, operating on massive scales and at absolute breakneck speeds that dictates whether our modern world thrives or collapses on any given day.
So I want you to imagine a scenario for a second. Let's say a massive corporation realizes it's facing a sudden, temporary shortfall. They need millions of dollars by tomorrow morning just to cover routine operating expenses. If that corporation misses payroll, it's an absolute disaster. The supply chain fractures, panic sets in, and operations literally grind to a halt. They simply can't wait weeks to secure a traditional bank loan, right? Now, on the flip side, imagine a government that needs to fund a colossal, decade-long infrastructure project. We're talking billions in funding that they won't be able to pay back for years. If that government halts infrastructure, the broader economy stalls. So how on earth do these massive entities survive a desperate overnight cash crunch while simultaneously funding those massive mega projects? It kind of feels like a paradox, doesn't it? Well, the answer actually lies in the architecture of the financial system itself.
The secret here is that there isn't just one giant monolithic market. Instead, the financial system is a massive, incredibly well-oiled machine powered by two distinct interconnected pillars. We hear these terms thrown around interchangeably by pundits on TV all the time, but they actually serve completely different, highly specialized purposes. Together, they form the key structural components of the financial market and play an absolutely crucial role in driving the global economy. We're going to unfold this gradually because understanding the precise contrast between these two engines, how they balance each other out and occasionally collide, is the absolute key to decoding global finance. Okay, let's dive into this first pillar, the capital market. This is the flashy, well-known side of finance. It's the one you see ticker tapes for, the one everyone talks about at dinner parties. By definition, the capital market is an environment dedicated to long-term securities. These are financial instruments that give their holders direct or indirect claims on capital. But what that really means in plain English is buying a literal piece of the future. When you acquire one of these assets, you are essentially purchasing a fractional claim on a company's future earnings or a government's future revenue. So when individuals, financial institutions, or professional brokers want to make long-term bets on where the world is heading over the next 5, 10, or even 20 years, this is the arena they step into.
Specifically, the capital market is where long-term investment happens. It heavily involves the issuing and trading of stocks and bonds. When a company wants to raise funds for a major business expansion, they aren't looking for a quick cash injection. Think about it, like a tech giant building a multi-billion-dollar semiconductor plant or an auto company retrofitting its entire global supply chain for electric vehicles. Projects of that magnitude require deep, sustained capital. So they turn to the capital market to issue these long-term assets, effectively inviting investors to fund their ambitious vision of the future in exchange for a cut of the eventual profits.
The mechanics of this expansion basically happen in 4 distinct phases. First off, companies issue new stocks or sell corporate bonds, which is essentially putting a price tag on their future potential. In step 2, investors step in and purchase these instruments, handing their capital straight over to the company. Step 3 is where the magic of economic expansion really happens. The companies take those massive pools of funds and use them to expand their business, build those factories, and hire thousands of workers. And finally, in step 4, the investors get to participate in the company's growth as the value of their initial investment matures over time. Their movements are continuously monitored and analyzed around the clock, with everyone searching for indicators that reflect the overall health of the macroeconomy and various industries.
But to truly understand the capital market, we have to look at how it's broadly divided into 2 main segments, the primary market and the secondary market. The primary market is where a company issues brand new stocks or bonds and sells them directly to investors or institutions. That's where the company actually raises its initial capital. But the secondary market, that's where things get really fascinating. This is where those stocks and bonds are actively traded between investors after being purchased initially. And here's the kicker. In the secondary market, the issuing company doesn't directly benefit from these transactions. They don't earn immediate profits from this constant resale activity. They simply sit back and watch, remaining intensely interested in the long-term appreciation of their share value, while everyday investors and massive hedge funds trade those existing assets among themselves.
Now, because we're talking about the future, and the future is inherently uncertain, the stakes in the capital market are undeniably high. This market focuses on long-term purposes, and, as a result, it generally carries a much higher level of risk. As you balance the scales of future expectations, the risk of a blown investment weighs heavily against the promise of massive wealth. But in return for taking on that risk, it offers greater potential for profits over the long term. Of course, this also means there are significantly higher chances of devastating losses if a company fails to deliver on its promises. It is the high-risk, high-reward arena where fortunes are made or lost based entirely on long-term future expectations. But what happens when you don't have years to wait for a return? What happens when an institution needs money right this very second?
And that brings us to our twist. Just when we think we understand how finance works by looking at stocks and bonds, we pull back the curtain to reveal a massive, almost invisible market operating aggressively in the background. It is the hidden financial engine, the money market. This is a completely different beast, operating on an entirely different set of rules. And frankly, without it, the entire global economy would literally grind to a halt before lunch. It's the lifeblood that keeps the day-to-day operations of the modern world flowing seamlessly, completely out of sight from the average observer.
Just look at the timeline we're dealing with here. While the capital market operates in decades, the money market operates at lightning speed, often literally overnight. We are talking about borrowing and lending operations that range from a single night to a few weeks to an absolute maximum of 1 year. It's this continuous, rapid-fire flow of funds transferring between institutions at a dizzying pace. This isn't about funding a 10-year business expansion or waiting for a factory to be built. No way. This is a short-term lending system designed for absolute immediacy. It is strictly about survival, stability, and immediate access to capital.
So the crucial point is that the money market specializes in trading short-term debt instruments. We're talking about highly liquid financial instruments. Essentially, these are cash-equivalent instruments used to meet immediate or temporary financing needs. It plays a pivotal role in helping entities maintain an appropriate level of liquidity on a daily basis. Think about it. Without this market, companies and governments would be forced to resort to incredibly costly emergency loans. Or conversely, they'd have to hold on to massive piles of excess idle cash just to make sure they can pay their daily bills. And in the financial world, cash that just sits still is cash that loses value to inflation. The money market solves this by putting that idle cash to work instantly, safely, and for incredibly short durations.
Now, what's really interesting about this slide is the fuel this engine runs on. Instead of stocks and bonds, this fast-paced engine runs on entirely different tools: bank deposits, repurchase agreements, often called repos, bankers' acceptances, and promissory notes. Take a repo, for example. It allows an institution to sell an asset for immediate cash today with a strict agreement to buy it back tomorrow at a slightly higher price. It's essentially a nearly instantaneous, fully collateralized loan. These are the tools used to cover routine operating expenses, manage payroll, or provide sudden working capital. They are absolutely not used to fund large-scale projects or capital improvements. They are the quick-fix, highly reliable tools of global finance, allowing massive daily operations to continue by obtaining funds rapidly and at a very reasonable cost.
And the players here? They are the absolute heavyweights of the financial world. When a massive corporation needs to cover payroll on a Tuesday, but the client payments don't clear until Thursday, they borrow from a commercial bank. That commercial bank, in order to maintain its own required reserves, might in turn use the Federal Reserve to manage their liquidity overnight. And at the exact same time, governments are constantly issuing short-term debt to keep the lights on and services running while waiting for seasonal tax revenues to actually come in. It's a highly integrated, suitable environment for all of these giants to park their massive funds for short periods, ensuring the entire system stays incredibly stable.
But, it's not just a playground for the institutional giants, and this is where it directly impacts you. Individual investors can also take advantage of the money market to protect and grow their personal savings. It's a safe and easily accessible environment. You can access it through a wide range of options, like mutual funds focused on government money markets, municipal funds, and U.S. Treasury funds. Many of these government funds are even tax-exempt, and you can easily open a money market account at most standard retail banks. It's an incredibly useful, highly secure tool for everyday savers who want to ensure their emergency funds are completely liquid while still earning a modest return instead of letting inflation just eat away at their hard-earned cash.
And this brilliantly illustrates the stark contrast between these two massive engines when we put them head-to-head. The money market trades modest returns for lower risk and strict daily liquidity. Its time horizon is an absolute maximum of 1 year, purely focused on short-term stability. The capital market, on the other hand, embraces higher risk in pursuit of higher potential returns. Its time horizon is strictly long-term, and its fundamental purpose is business expansion and structural economic growth. Although returns in the money market are usually pretty modest, that crucial lower risk makes it a relatively safe investment option, perfectly balancing the high-stakes, long-term bets of the capital market. Simply put, one provides the foundation, and the other builds the skyscraper.
So as we pull all of this together, it becomes pretty clear that these aren't separate, isolated systems fighting for dominance. They are two deeply interconnected pillars. The money market provides the day-to-day liquidity, the short-term breadth of the economy, ensuring that banks don't fail overnight and companies can reliably pay their workers. The capital market provides the long-term vision, the structural growth that builds vast new industries, funds innovation, and pushes human progress forward over decades. Together, locked in this intricate dance, they form one unified, highly dynamic global financial system.
So the next time you look at your own bank account, your retirement fund, or your investment portfolio, I want you to ask yourself this lingering question. Which financial engine are your savings fueling right now? Are you providing the critical daily liquidity the world needs to survive until tomorrow? Or are you funding the massive expansions that will shape our collective future? Understanding exactly where your money sits in this grand, interconnected machine is the essential first step to truly mastering your own financial journey. Thank you for joining me for this explainer, and keep questioning how the world around you really works.